On this video, I'm going to discuss the loan assumption process. This is becoming more and more popular, especially now that interest rates are higher. Current loans could be much more attractive to assume from a buyer. So the number one thing that we are doing as a team is making sure that we ask every owner that's selling, is your current loan assumable? It might be able to get you a better price because there's better interest rate financing that a buyer can assume than the current rates that are offered in today's market. So let's dive in. Here's a couple things you need to know or think about and do on the front end before assuming a loan. We had just put together a loan assumption on a building in Orange County, which sparked this video, and these are some of the things that we went through. Number one, we asked is, what is the timing of the loan assumption process? We were told start to finish, it's gonna take a total of 45 days. That's best case scenario. So we wanna make sure we manage expectations on both the buyer and the seller end to make sure that we can execute, because sometimes assumptions take a little longer than getting a new loan. Number two, buyer qualifications. You want to make sure that the lender connects with the buyer and make sure that they're qualified enough to assume this loan. The lenders want to make sure that they're not taking on any additional risk, or just maybe the loan is with a great borrower that has a high net worth. They want to make sure that that new buyer is equally as strong. Number three would be, what are the costs to assume a loan? For this example, on the Chase loan, the costs are 1% prepay plus a $2,000 processing fee. So we got that information on the front end. We know what the costs are. You want to get that as well, because you don't want to be downstream in a deal and then not know all the costs. And then also you want to make sure that is the existing loan amount, the entire amount that can be assumed, or will the lender require that the loan be drawn down a little bit to lower the amount of proceeds? And here's why sometimes a lender can do that. Sometimes they didn't account for the higher property taxes. They didn't adjust for the property taxes to reset if there's a sales price. So there's a higher sales price, they didn't underwrite for those taxes to go up, which can cut proceeds. In our example with the Chase loan, we found out on the front end, the loan would go down from approximately $2.5 million down to $2.2 million. So hopefully this is some framework to get you ahead of just a loan assumption, knowing about these things on the front end. So if you're gonna be buying an apartment building with an assumption, these are some things to think about on the front end. And I think this is gonna be a growing trend as rates, if they stay higher, then a lot of debt was put on in the very low 3% ranges, and those could be attractive loans to assume. So hopefully you found this of value. We'll continue to keep putting out good information. Thanks so much for watching, and we'll see you on the next one.